yeah, probably reshaping the landscape of lending markets, and lending markets, vaults, and everything that surrounds that has risen to become pretty much the base layer of yield farming over the past couple of months. And there have been several events at the end of last year with the stream collapse, and a few weeks ago with the Resolve exploit, that have opened up a lot of questions of how lending markets will evolve in terms of risk management, in terms of liquidity crunches and yields compressing. So I'm very excited to have you on the show today, and hopefully we can together discover some solutions to the current issues.
Thank you, Max. Thank you so much for having me. A lot to unpack for sure.
Yeah, can you give us a brief background about you, how you joined Silo, and how the team came to be?
Yeah, for sure. I've started contributing to Silo in about August, like probably actually early 2022. We launched Silo officially. The first version was August 2022. So before that, I had done a couple of blockchain projects, not in DeFi, outside DeFi. My background is in engineering growth for startups, and I moved to DeFi, or I moved to basically blockchain space since in 2016. So that's my background. I contribute to Silo today alongside other contributors, and I mainly focus on basically product and growth. So super excited about telling you, super excited about the V3 and telling you about it.
What was the original idea of Silo, especially since lending markets were nothing new back in 2022? You had Aave. I'm not sure when exactly Morpho launched, but I think it was already around back then. So what niche, what gap did Silo try to fill, and how did that evolve over time?
Exactly. So the idea of risk isolation, we have to attribute it to a team called Kashi back then. Kashi, they didn't follow on the idea, but actually they came up with the idea of risk isolation. I think it was part of it was a product of Sushi, the organization, the DAO itself. So they just didn't really follow up. They had a lot of good ideas, but it was the idea was, if we have Aave and Compound, and it's a shared pool lending, basically cross margin lending. You have to trust every single asset in the pool, because when you're lending your USDC, any token in the pool can actually borrow USDC. So you need to, number one, make sure that all the tokens in the pool are basically solid and cannot be exploited in any way, and they're all liquid on DEX exchanges and can be sold to repay loans and all this. It's a lot of work. So Aave actually all shared pool have to have, number one, very very close kind of like eye on risk parameters. Number one. Number two, they need to track liquidity. Number three, they also limited to highly liquid assets. So it was very very restrictive in that sense, and also it's very super risky, and that's why you have like a safety modules and things like that, because you have to have a lot of liquidity. You can touch on how risky it is. Like recently, for example, in a shared pool model, Fluid, because of the Resolve, we should actually, because it kind of cross-contaminated the entire pool, and they didn't have something like a safety module, so they had to raise money to repay, to fill basically the gap on the paper. But anyway, so back then that was the idea. So it was like risk isolation is needed because there's just a lot of assets that deserve to have access to credit. But back then we weren't even talking about like a new wave of stable coins, or like reward assets, or even vault assets or locked assets. This was more like, in our mind, was like, okay, this is definitely coming, but we have to prepare for it. So Kashi came up with the idea. We kind of inherited, but we improved it. And the goal was, we want to give credit to every single asset, but we have to isolate risk. You cannot have a contaminated pool of, or possibly contaminated pool of assets. So you have to basically create what we call them silos. We still call them silos. Every silo, basically every market consists of two silos only. So if you're lending USDC to a silo, you know that there's only one type of collateral that can borrow yours, so you can choose your risk. You can actually kind of choose your risk. You know that you're isolated from the entire system. So that was really the idea, and we kind of back then, no one really. We were the only ones. So we kind of like started this idea, and we kind of propagated really this isolated design or risk isolation. And we started really trying to educate users because back then everyone thought like, oh, if I lend my USDC to Aave, there's no risk because I'm isolated. No, you're not. But then still, actually, a lot of users still don't know until even today, they still don't know. But that was really the idea. And of course, with V1, we launched V2, we improved it, and now V3, we kind of really changed the core mechanics of how lending markets work.
So you're much more similar to a Morpho than, let's say, an Aave or uh, a
Yeah,
Dolomite, right?
yeah, exactly. So actually, Morpho, when they started, they were like more of like liquidity optimization layer on top of Aave, and then they did see that Silo have actually validated there is a valid there's a market in the risk isolation, and they of course then attack the market and they kind of like spread it or basically propagate it even to a wider audience because of the reach they have. So yes, definitely we can. Avi V3 tried to attempt, or actually attempted to create kind of like isolated as well, isolated solutions. But now V4, I think V4, I haven't really looked much into it, but I think they also you can create isolated markets with Avi V4. So because now we know that this is actually the right way to do lending. You cannot really have this pool, this idea of a shared pool lendings. It just doesn't scale, and honestly, it should cease to exist, in my opinion. I have my argument.
So you can customize more on the risk management side with isolated pools, but on the other hand, it fragments liquidity. And especially throughout a downturn in liquidity and market participation overall in DeFi, which we have seen in the past 6 months, how would you say the user behavior has shifted between these generalized and collectivized exposure pools, like you have it on Aave, versus the ones you have on Morpho and Silo, which are more on the isolated side?
Actually, on the Morpho side, most users still use the shared the basically shared multi-asset vaults, which is similar. Really, the risk is similar to the risk you get on Aave, but without the safety module. So I would actually argue that uh, Morpho Vaults is as risky. It's probably riskier than Aave V3 shared pool. Because when you deposit your USDC to a vault, and let's say that vault is managed by Gauntlet, like exactly what happened with Resolve recently, you're also exposed to all the assets where the vault can allocate liquidity to. Uh, so it's really not that safe for users. We do have actually even managed vaults ourselves, and we call them multi-asset vaults, multi-asset exposure, because now you're not exposed to single asset like in isolated markets. You're basically exposed to multiple ones. So yeah, we're Silo is this is where we operate. We still try to push the risk isolation narrative on users, but I still think that users will always they so they users will always seek the highest yield possible, but they don't really do much diligence on risk. So whenever they see a good APR, they just deposit, and they don't really. The behaviors haven't really shifted that much, to be honest. So you still can see you can still see that users deposit even still IVV3 or shared vaults on Morpho. So the dynamic hasn't really shifted much, and I think that's due to the obfuscation in DeFi and due to there's just an idea that they assume that there's some team that can actually protect you there's just some weird assumption that there's basically, although DeFi was built on the idea that do not trust, always verify, unfortunately, that doesn't work anymore. I mean, that stopped that narrative. That people just forgot about it. So really, the behavior hasn't really shifted much in DeFi, and so it's as risky. It's actually way riskier today than it was when it started.
What were the limitations that V2 still had, and how are you trying to improve that with V3?
Yeah. So lending markets, the biggest risk of lending markets, there are actually two types of risk. The risk that comes from the collateral itself, the token, something happens to it, exactly that's resolve, and that's the stream finance. So all of a sudden, there's a collapse in collateral value because someone infinite minted it, for example, number one, or simply the underlying, the backing was lost, like stream finance. Just simply someone gambled too much and you lost 20% of it and gone. So that's like risk number one. And that is very difficult to track. That is actually the most difficult one because who knows? I mean, there's just someone can sign on signatures and things like that. We can get to this. The second type that that lenders, the second type of risk that lenders face into it, not just the collateral itself. So you have to trust the collateral, of course. The second one is liquidity. If I am a borrower, if I become insolvent, meaning that I have some part of my collateral needs to be sold to repay my debt, to reduce my debt, I have to have a way that the protocol has to have a way to sell that collateral to repay the debt. So liquidity is a problem. So every single asset that in lending, in the lending space, the collateral have to have enough liquidity on dexes. So V2, Silo V2 works like any other lending protocols. The problem is that a lot of assets are not liquid. So if you use that asset as collateral to borrow USDC and that asset has no liquidity, and now I need to liquidate you because you're borrowing too much, well, how do I sell? Where do I sell this liquidity, right? Where do I sell this collateral to get the liquidity? There's just no DEX liquidity. We know that DEX liquidity disappears in times of crashes like market crashes or like any stressful event, it disappears. A lot of assets do not have liquidity at all because they're just vault assets or real world assets that have off-chain fundamental value but not on-chain, or some assets simply have liquidity but not enough liquidity to actually sell and liquidate. So you have, let's say, an asset that has $100 million of that backs 100. So take this example: you have a collateral that backs up $100 million of loans, but only have $1 million of liquidity on chain, and that just doesn't work. So we kind of re-engineered this how it works. We thought like, okay, if the collateral itself has actually value and you can always redeem it somehow. Sometimes you can redeem it after 1 day or 2 day or even 7 days, or sometimes you go off chain and redeem it, or sometimes there's a lock, like a vault, you can actually redeem it after 3 days. If the collateral has value, and why not distribute the collateral itself to lenders if we cannot do DEX liquidations? So say that you're lending $100,000 to against a real world asset, and a borrower becomes insolvent. So we need to liquidate. We can't liquidate, so there's just no DEX liquidity. I can actually give you the collateral itself, which is a real world asset in this case, plus all the liquidation fee, which can be customized depending on the collateral risk. And then you, instead of having USDC as a lender, you withdraw this basically real world asset plus the liquidation fee, and you go about redeeming it. And again, if the asset has value, it's not a problem. It's probably a delay of 2 or 3 days for you. Like think of all these LSTs that have actually claim on underlying ETH or underlying any kind of asset. These assets are actually fundamentally valuable. So there's no risk for users at all. But I've solved the problem immediately when the side of V3 liquidated, they solved the problem of actually solvency. So it kept the integrity of the market. Because if there is a gap, if you cannot liquidate, and now, like for example, in the resolve issue, when you could not liquidate, what happens is all lenders, USDC lenders, try to withdraw their money first because the risk liquidity. These markets do not unwind. The first to get out of the door, the first to withdraw actually wins or survives basically, and the last people in the pool experiences the loss. That's why. So it's the bad debt is never shared. So if you withdraw your $100,000 first before others, you're fine. But if you're the last, you're gonna actually take on the entire losses. So these markets are unwind, like they don't unwind. So whenever you know that there is actually a problem in this market, you try to withdraw your fund immediately, and that's a problem. So these markets become problematic. There's no liquidity, interest rate increases. Now borrowers pay a lot. You cannot liquidate. These markets basically unravel. Inside of E3, it's very simple what we do. There's no DEX liquidity. We give you the collateral, we reduce the debt, and the market basically keeps functioning. Now, lenders need to trust the collateral to begin with. So some people say like, hey, but I lend USDC. I don't want this real world asset. I don't need it. So don't give it to me. It's like, hey, but I actually rescued you. I actually gave you a great alternative. This asset still has value and hasn't reduced in value. And actually, you got probably 5 to 7% extra in liquidation fee. That translates probably to a year of yield that you just got in one liquidation event, and then just go about and redeeming it. So I kind of like protected you as a lender because there's no DEX liquidity. So this can happen a lot, not just for real world assets. Any really asset that can lose its access to liquidity, and especially, for example, let's take, for example, bridged assets. They're liquid on Ethereum, but they're not liquid on Avalanche, for example, or something else. Or like a market maker stops, removes 90% of the liquidity in one event because of one event on Ethereum, and there's no liquidity anymore. So that mechanism becomes extremely important to protect lenders, but also opens up doors to providing access to really any types of asset, as long as the lenders trust that type of collateral.
So V3 is mostly an improvement on the liquidity side and trying to prevent these contagion-like developments that we have seen in the past, where if there's a failure on one market, it trickles down to a ton of others, liquidity crunches, everybody is trying to exit, and then there's just such a rush towards liquidity pools that they cannot satisfy the demand. Then like additional assets depeg, and that way like this whole kind of domino effect goes on and on. But it does not fix anything on the, well, if the collateral is actually below value, there's still like some risk left, right?
Yeah, I mean, if the collateral loses value, lenders lose anyway. They're losing anyway. Today, and that's usually, and we're not talking about a volatile collateral here. Like we're talking about, it's probably losing value is not the accurate one. They probably like losing fundamental value, like not just decreasing in price. Like something happens to a stable coin, and now it's worth 80 cents, not $1. That event will lead to liquidations. If you cannot liquidate because there's no liquidity on DEXs, we can still liquidate. Silo V3 can still liquidate and that collateral and give that collateral to lenders, and the lenders will have that instead of not having access to any liquidity, because in those events usually they zero out. This is lenders cannot withdraw anymore because those borrowers have borrowed everything.
Can you screen share and walk us through the mechanism? Maybe if you're able to get to the liquidity crunch we have in the last months, maybe both Stream and Resolve as an example, where in that cascade would V3 have offered a significant improvement to what we have seen on Ravel and other lending markets, like mostly Morpho, but maybe also even Silo V2 and some of the others?
Yeah, I mean, we don't have access to kind of like a way to simulate what what can actually happen, or how Silo would behave in relation to others, but I can what I can do is probably share with you 1 second, uh, like a diagram that probably explains how this mechanism works, or how this protection works for lenders. 1 second here. Uh, okay, here we go. Let me see if I can share my screen now. Screen. Okay, so let me know if you see this diagram. Yeah, I think you can. I can see it, right? Do you see it, Max? Yeah. Okay, great. So usually this is a borrower, and we have a borrower on the left, and we have a lender on the right. So you're basically you're the lender, I'm the borrower. So I'm borrowing USDC from you. If I become insolvent for any case, for any reason, I try to the protocol basically try to liquidate through the traditional liquidations here, like Uniswap, whatever. And then basically the liquidations will repay USDC, and the USDC will be available on the pool. If you want to withdraw it, you can withdraw it. If you cannot do this for any reason, and again, there's a lot of issues that can happen that will prevent this liquidation. In our case, what we do, we take your collateral, which is and we send it to lenders. So in this case, for example, the collateral is actually SCSDE. So it's the staked version of Athena, USD Athena, or Athena USD. So lenders, instead of withdrawing USDC, they will actually withdraw USDE. And plus the liquidation fee, of course, they'll earn the liquidation fee. So liquidation fees just go to lenders in this case. Now you take this SCSDE and of course redeem it. If you can sell it on DEXs later, you can, great. Or maybe you'll probably have to unstake it on Athena and manually, or if you maybe even can automate this and just simply redeem it for USDC. So that's really how it works. Now, if you want me to kind of walk you through how this would have solved the stream finance issue, not really, not in the sense that you will get the USDC back, but what happens when these lending markets like stream finance, borrowers never repay, lenders cannot withdraw USDC, and also lenders cannot have the collateral itself. Now you might ask me, like, why would having the collateral itself help me as a lender? Well, if you have Stream USD, for example, I don't know, I forgot the name of the stable coin, but if you have their own stable coin, you might just hold it until there's for example, there's a solution that which basically is coming up soon, I think, where you can actually redeem at least for maybe 70% or 80% of the value. But if you don't have access to that collateral, it becomes extremely difficult for USDC users to get anything really out of it. So to solve this problem, Silo V3 can actually give you the resolve token RLP in this case, for example, let's say, and then you hold this RLP in your wallet, and then you try to redeem it through when, for example, RLP is working on the redemption mechanism right now. But in traditional lending markets, there's nothing. You cannot withdraw your USDC, and you cannot even receive the collateral itself. So you end up with zero. And even if there's a redemption mechanism that opens up, you don't have the collateral itself. So you're not even you're not protected as a lender. You get nothing. So yes, you might argue like, well, if I have RLP, this is not as good as having USDC. That's correct. But in worst case scenarios, that's the only thing that actually lending markets can do, can give you the collateral itself. Very much like what happens in tradition, like in the world, in the real world, when someone defaults on a loan, you try to see seize the asset itself, well, how can you even distribute this to those to lenders, right? Yeah.
Can you, both on a qualitative, on a quantitative level, how does the risk reward of lending to individual markets changed with this new feature from a lender's perspective? Because for now, if you are very active in the market, if you're technically savvy, if you're able to monitor developments block by block, and you are quick to withdraw, you're not really exposed to so many tail risks if you're just able to get out early. And for all the people who are less sophisticated, many retail participants who just want to park their money into something, but who do not have the capacity to monitor something constantly, they are, even though they are in the same market, they are faced with a much, much inferior risk reward ratio. So how does Silo V3 change that, both on a qualitative and, if possible, to calculate on a quantitative level?
Right. Well, I mean, it's almost right now. It's extremely difficult because even to withdraw fast. By the way, you assume that someone can withdraw fast, but it's what? How do you know? What are the signals? Well, you have to listen to a lot of signals in order to decide if this market is going bad or not. And these signals usually like alerts from someone monitoring events. There's some infinite mint, like what happened with, or like unusual mint, what happened with the Resolve token or whatever. Silo, what we do, we usually when we set up the lending market, we set up high or like we adjust the liquidation fee such that it compensates lenders. So the premium they get from liquidation event can compensate this potential delay in having that asset redeemed for the underlying asset. And again, we don't assume that this collateral will lose value. I mean, usually when we set up these markets, when you're lending, you have to trust the collateral. Whether it's you're using Silo V3 or using Aave or using anything, you have to trust the collateral to begin with. What this mechanism is doesn't remove this trust factor. You have to trust it. But then if something happens to the collateral, and let's say it loses 5% of its value and you cannot liquidate, well, this is what we do. So the first line of defense is when we set a good loan to value. The second one is the liquidation fee. The liquidation fee itself can compensate you for receiving the collateral itself. And that can be actually quite good. So we can set this liquidation fee to be 3% in some markets where we know that the liquidations almost never happen. Or in some markets, we can set it up to 10%. In some markets, if it's a meme coin, for example, which we don't have today, but if we could, this liquidation fee can even be 20%. So you know that if I end up with this volatile asset, I'm actually getting 20% on top. So that could be actually a good buffer for me. So when I receive it, I go to redeem it, and it's actually probably I've made money on it. So liquidation fee can be set that it compensates the user for the risk. Again, it does not compensate the user. It doesn't remove the risk of actually the collateral itself losing value, but it's actually very viable, great solution if you trust the collateral. And now on Silo, we only trust the assets that in DeFi, it's kind of like there's a consensus that these assets are issued by good actors. But when things happen, when bad things can happen, this mechanism actually really protect lenders. So in this resolved situation, you would have ended up with the RLP immediately, for example, because RLP actually depegged. It was kind of like mostly used as collateral in lending markets. You would have used it, and now you would have it in your wallet plus the liquidation premium. And now you're waiting probably for RLP to open redemptions. In Morpho and other on Fluid, you haven't received anything. Or probably in Morpho, you as a lender, as a USDC lender, you have not received the USDC, and you have not received even the collateral itself. And now you're just basically you don't know what's going to happen.
Who would you say benefits the most from V3, and who will be the most active users? Will it be other DeFi protocols and vault managers that have the size and the professionalism to maybe sit through duration when it comes to redemption, and also are sophisticated enough to employ any legal means against potential RWA issuers to redeem it? Or do you think that V3 will mostly appeal to the day-to-day DeFi user who's more on the retail and pro-tail side?
Well, I mean, we've seen it right now, even with even if you think that you have legal means and you have really sophisticated operations and you're a business, you can't still go about redeeming your or fixing these issues as a lender. I think this is definitely right now. Lenders should retail lenders should actually start using these markets because it actually protects them. So it's certainly way safer than any other lending markets. Now, I think about vault managers, uh, it certainly protects them as well. But if basically they admit that collateral can go wrong, or like some collateral can actually lose value, some of them they still don't, and they think that they have mechanisms in place to stop it. They can't. There is not any mechanism. So I think this is really mostly for the savvy retail and also savvy users that understand the risk implied in DeFi and wants the maximum security for the USDC. And these markets still earn actually higher than other lending markets. So they're not when you're using these markets, you're not only protected, but also you're earning a comparable yield is even higher. So you're not basically sacrificing on the yield to earn this extra protection.
To zoom out a little bit, how do you view the lending market competitive landscape right now? And how do you think the launch of Silo V3 will impact and ideally better your position in said competitive landscape?
Yeah, we've got actually right now in DeFi, there's two basically models. There's the risk isolation model, and there's a shared pool model still. These two models like this. So basically, you've got like Silo slash Morpho on the side, and you've got on the other side more like Aave and an Euler, like more like shared pool and isolated pools. Now, that's kind of really the competitive space. Obviously, Silo is not as big as the rest, but now we want users to understand that you have to use risk isolated markets or basically silos, or like whether that's Silo or any other lending market. But risk isolation is fundamental because if something can go wrong, it will go wrong. Like if you are in a shared pool and even in a shared vault on Morpho, and if you don't trust all the assets in the vault, you should just stop using it and go directly to the risk isolated market, to the Silo in our case. So that's like really the landscape today. And DeFi is mostly concentrated. It's a really small space. DeFi is a super small space. If you remove if you really want to lend to fully decentralized assets that do not go wrong, like that's probably less than 5 assets in the entire space. And the rest of it is real world assets that have sophisticated operations or basically kind of like feed that capital to other lending markets that can actually expose users to things. So risk is layered, multi-layered. So it's very difficult. So that's why we think that Silo V3, because risk is very difficult to understand in DeFi, we think that Silo V3 is the best place actually for lenders to use today to protect themselves, and even not just for lenders, even for borrowers, because some borrowers just care about the collateral itself and they want to they want it. Yeah, so I think that's pretty much like the landscape today.
How is Silo currently positioned to capitalize on the significant trends in DeFi? I would say there are two trends. One of them is that retail and pro-tail participation is down, mostly because yields are compressing and the capital pool of DeFi native capital is becoming more and more desperate for returns, less interested in directional exposure because especially most altcoins and even the majors like ETH and Sol have underperformed quite badly over the past couple of months. And the other trend is that there is a lot of stuff happening when it comes to RWAs, tokenization, and getting the space ready for institutional players. How would you say Silo is positioned there, and what is your current growth strategy? Also looking at your prior TVL highs of in the several hundred millions, when you had a lot of like campaigns
Right.
going and were an
Yeah.
essential part of looping up certain things on certain chains. And
Okay.
how are you trying to exceed these previous growth and adoption metrics?
Yeah, well, I just focused on the first one because I think DeFi is not even yet ready to receive institutional funds, the entire DeFi, and we're a small part of it, a tiny part of it. And that's for many, many reasons. I don't think we want to cover this here. So I'll say that right now in this market, yields are compressing. Everyone is getting desperate to get the yield they need, or they should get. And that means that we'll risk uh, strategy operators, and we'll probably go to the higher up the risk curve, and that's going to be a problem. Meaning that will be like more like riskier strategies, and that's going to be a problem for lenders because usually these strategies are difficult to understand or track. So risk isolation becomes more important. So if you want to bet some money on these strategies, or like you can participate, deposit them in Silo, borrow USDC, and some of your money, but that's going to be a problem. So risk isolation becomes more important. I think it's probably a good thing that at least users start kind of to care more about understanding risk and understanding what's happening. So I think right now we're waiting for the institutional money. I mean, everyone is waiting for it. I don't think DeFi is ready for it, to be honest, and I don't think it's just about tracking risk and all. I think it's more of like on the smart contract level, because you cannot really guarantee that there's hacks do not happen. And the system is open, so that's going to be always a major problem for them, because if you think that yeah, well, I'll deploy a strategy. I'll deploy into this simple battle tested vault. Sure, but if that vault shares with other you know collateral, and then one of them becomes bad, then you have a problem, and hacks happen or funds get stolen and never paid back, and you cannot really close the system. So that's one of it. So risk tracking is difficult in DeFi. We cannot really prevent capital from them fleeing or getting stolen and laundered. That's a second big problem. But as far as the first the point that you raised is like in general right now, risk is definitely going to become going to be increased for all lenders, and I think lenders should start caring about risk isolation. Which, by the way, on Salo V3 we do have a sophisticated section for each collateral that outlines the collateral itself, what it is, who issues it, the risk factors in it, to understand if I want to lend my USDC, I need to understand if this is a high risk, this is a medium risk, this is a low risk collateral. And of course, we also outline the liquidation and how that happened, and then the Oracle, how they work, and if there's an admin that kind of basically rescue you or help you or not. So all just to help users understand risk and decide eventually whether that is a retail user or the savvy user or the trader or even a fund.
What are the lending and deal opportunities that are live right now on Silo, which you would find particularly exciting? And maybe screen share and walk through the application.
Yeah, I can actually share with you how I personally evaluate risk for even my own money. So this is Silo. If you go to the earn section, let's say I have USDC, I'm just not gonna go something else. Just I have USDC and I go to the risk section here. So I have two types of vaults that I can participate in. Multi-asset vault. So basically if I lend my USDC, I'm exposed to all these assets, the risk of all these assets. Maybe I say like, this is too much for me. Like I don't wanna allocate my funds in this multi-assets, because again, I have to trust all of them. And then I go to the single asset vaults. These are the risk isolated markets. And then I look at, for example, like, okay, this is CUSD, it pays 4%. That's a medium risk, whatever. Maybe this is not much. Uh, so let's say I decide I want to actually check out this. It's pays 10%. It has some liquidity, so it's on Ethereum, and it's called PT RESDE. I click on it, and before I basically supply the money, I decide to read the risk section. As okay, I want to understand what is this PTRE thing? What is it exactly? And I read, and there's a lot of information here, of course, but yes, it's important to read actually. So you understand that REUSD basically it's issued by the RE protocol. It's a structured capital system. You know, it kind of reads. It's a reinsurance basically product. The team is actually based in San Francisco. It's a reputable company. It's reinsurance, and there's actually risk factors here that we outline to you. We say basically it's not a first loss capital. If something happens, you actually protected, whatever, whatever. So you understand, okay, this is what the collateral is. Maybe I understand it. How this liquidation works, we basically tell you like, hey, if something happens, you can actually get the collateral itself and redeem it. We tell you about the Oracle. We tell you about there's even a live risk report that tells you, like you can even see who manages the underlying asset and all these kind of things. We even tell you if there's a bad debt in the market, so you can know now immediately that actually this market is healthy, it's 100%, there's no debt impact. And of course, we tell you all the information. And then now that maybe I'm ready to actually deposit. So I'm actually really excited about this market specifically. I usually use isolated markets all the time. I never use vaults. Sometimes I do. I actually trust the silo vaults that are managed by the silo DAO itself. We have a couple of them here because we know that we're very, very careful, but nothing is perfect. For example, like this vault, ETH vault is on Arbitrum is actually have 11 million, and it's a low risk. Why it's a low risk? Because if you go to the composition of the vault that you see, this multi-asset vault allocates to WETH, it's a reputable market, 48%, staked ETH, Lido staked ETH, it's good, and RSETH, it's also a reputable market, it's fine. This is a medium level, but overall it's a low, so this is maybe it's fine for me. But I usually try to just allocate my capital to isolated markets. And now with AI, maybe you kind of like employ a simple bot that tracks yield and maybe every week reallocate and just become like a little bit of fund manager yourself. Yeah,
Are
so that's kind
you
of
constructing all of these risk metrics yourself, or are you partnering with some providers of like individual parts in BetStack, like verifying the backing with Accountable, or some like yield and risk ratings like Vaults.fyi and similar players in that
yeah. Well,
space?
that doesn't exist yet in. So we're doing it ourselves right now. It takes a lot of time because that doesn't really exist in DeFi yet. So what we tell you basically here in the risk section, let's say of this market, we go to the risk section. We tell you like if you go to the additional commentary, we tell you like, hey, you really have to decide yourself eventually. Like we cannot really be. We're just helping you here. We're like here to help you decide, but we cannot tell you 100% if this is correct or not. So you're the one that decides. And this is DeFi. It's not meant to be for users that do not understand risk. If you really do not understand risk and you don't want to really even understand it, or maybe you cannot understand it, simply just go for the simplest market, the collateral, and lend to it, isolate it, and be content with the 3-4% you make, and that's it. But if you want to go up the risk ladder, definitely there's a reason why these assets pay higher because the risk is higher. But I'm personally like excited about the assets that we have today because I know the teams, I know that they're actually really solid companies, and yeah, so it's like really like for example this one is good. Avant team, they have a couple of assets that we with us from Avant. They have um, come out come out the October event last year really strong and like honored every redemption. So now they actually, to be honest, like they have kind of like earned status in the space. They have multiple assets. They have like Savvy SD. They have multiple type of assets. with us, like SavvyUSD is kind of the biggest one. So yeah, there are a couple of good opportunities. Again, it's that risk is certainly outlined for users to understand and eventually make the decision themselves, you know, and say like, okay, I want to understand this collateral, how it works. If there's protection mechanisms and whatever.
Earlier, you mentioned that you're mostly allocating into isolated markets and not into vaults. I would say that over the past, let's say, 8 to 6 months, everybody has been shilling vaults as the future of on-chain asset management. How do you see that entire space evolve, and what would need to change on the curator and curator infra layer for vaults to become more attractive for on-chain asset management and to be the superior way to allocate into investment opportunities on-chain?
Right. Well, if the curator is charging you 10%, 15%, they should, this 10, 15% not just, for optimizing the yield. It's also should be for protecting you from losses. Um, uh, uh, I think the model is definitely broken today because there are many curators today that do not add assets to their vaults based on fundamentals. They just add it because business development opportunity, they have deals behind, behind closed doors that you and I don't know about. Like, yeah, we'll share the yield or we'll even pay you in tokens. This, for example, new assets like, I desperately want TVL, so I'll give you 1%, 5% of my token supply and things like that. So I think this space, I can question the integrity of many of them. And I think every single user should just assume that there's no integrity in the space. And maybe this is too radical, but that's the best way to really protect your money. Just assume there's no integrity. So the system is completely broken. And to be honest, it should be broken. This is DeFi. If you can't verify, just don't use and just use the isolated markets. Use them. Do not use these. So if you want to fix the problem, if you want to fix this, a curator has to clearly outline why they've added these assets to the vault, the methodology, and they should say that they have not received any, compensation or anything like that. There's no conflict of interest for adding these assets, and they have also to outline to you how they're tracking the risk of every single collateral. So if there's a team that's signing signatures off chain, like the Resolve team, for example, you should be able to verify that and track that as well. And that was an unfortunate event, but with the Resolve problem was in the contract itself, you could arbitrarily mint any amount as long as you're the admin. So if you have to trust the admin. So users did not know about that, and some of the vault managers didn't know, and some of them they knew and didn't disclose. So you see now the problem. So it's really complicated problem. So you have basically to trust someone. Okay, I right now in DeFi I shouldn't trust because there's no legal behind me. But maybe in traditional finance you can trust an entity because it's highly regulated. You can't trust your bank. Well, I mean, to a degree, right? But at least you know that there is a government. You can actually sue them. You can do something. You can, really do something about them. It's regulated. In DeFi, it's not regulated. So if I tell you like, oh yeah, I've vetted every single collateral in my vault, and this is good to go, and you trust me, you're a fool because most of the time actually they don't know what they're trusting to begin with. So maybe they're good actors, but they don't know. And we've seen this with stream finance. We've seen it even simply with Resolve. Probably like Resolve is a very good team, and they didn't do anything really to be honest, something wrong. But it's unfortunate what happened. But the vault managers that trusted them, they should have had access to every single component of all these, um, potentially like points that can go really that can fail, and disclose them to the users. But at least now they're coming out saying like, hey, we're going to compensate users, we're protected, which is really a good I think signal. But bottom line is, I don't think there's any solution to that, and at least now, and users just should use lending as isolated markets, like purely isolated markets, just one asset at a time, and sacrifice a bit of that yield. In many cases, you don't even have to sacrifice the yield.
What is your outlook for the rest of the year? And related to that, what would success look like to Silo until end of year 2026?
Yeah, now we're just navigating the very volatile market like everyone in the space. We don't know what's going to happen. The outlook in the Middle East is very grim right now. I don't think, so for us is more of like pushing this narrative of risk isolation and risk disclosure and try to sell on these 2 points and get lenders to lend to assets that we think they're good assets. Because yes, we do not guarantee that, but we only list assets that are actually reputable on the UI to begin with. So it's not like, but again, this is for now. We'll see. I think we're definitely seeing a lot of real world assets, and more sophisticated strategies underlined by new assets that can actually have lending markets. So strategies are still getting more sophisticated and still play like off chain. So to have like big off chain component, which is risk is going to be getting higher. Really excited about this, and I think Silo V3 is positioned to capture a piece of that. So we're going to be pushing hard on that. So that's really what gets me excited. More like working with the off-chain or like reward assets, because Silo V3 is perfectly positioned for that.
Very much looking forward to that. I've been following Silo since the very early days. So yeah, I hope that you guys will be able to evolve and thrive in the changing market conditions, and with the space changing more towards bringing real world assets on chain instead of only shifting and trading crypto native assets. Where can people find you? How can they reach out if they want to allocate into Silo or work together with you guys?
Yeah, it's simple. Just go to silo.finance and then you can access the app from there. And if you have any questions, just reach out to us. We're very active on Twitter. Email us as well if you want to have like a talk with the team. You understand more of the risk of a certain asset. We're happy to share that with you. We're available like all the time. So appreciate it, Max. Thank you so much for this great interview.
Thanks a lot for coming on, and hopefully we'll be able to see you again on the show.
Hopefully. Thank you so much.
Have a good one.
You too. Bye.